Welcome to Market Catalyst. I'm Brooke DePalma. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, gold's record rally continues. The precious metal on track for its largest annual gain since 1979, after hitting more than 50 all-time highs in this year. How should investors be thinking about the asset right now? We'll get more to that. Plus, gas prices falling to four-year lows, what drivers can expect in 2026 with possible oil supply risks on the horizon, and financial resolutions to consider for the new year, what retirees should be asking as they position their portfolios. Let's get a quick check on the markets. All major averages trying to hold on to some momentum, trying to hold on to that Santa Claus rally. Sticking with the S&P 500, mostly flat, up about 0.05% as we move into the day. But we are looking for another record close. In order to be another record close, the S&P 500 needs to close above 6,932. Right now, hovering or just around that, moving just a tad lower. And if that does close, that will be the 40th record high this year. On Wednesday, if you take a look over the past 5 days, we did have another record close, so we are looking for it to close above that 6,932 mark. Taking a look at the Nasdaq, seeing some downward momentum in intraday trading at the open here, down about 0.1%, and the Dow also moving just a tad lower, down about 0.07% as we make our way into the day. But I do want to take a look at crude oil, because crude oil prior to this morning was on track for its biggest weekly gain in 3 months, and now we are seeing some pressure, down about 1% in intraday trading. If you take a look over the past 6 days, what we did see was some momentum there, up about 2%, but now because of geopolitical tensions, we are seeing some downward momentum. We'll talk a lot more there this morning. I do want to take a look at the sector action, because we are seeing some rotation this morning with consumer staples, materials, tech, real estate leading some momentum, communications, as well as consumer discretionary moving just a bit downward. Financials and industrials also moving lower this morning, as well as energy and healthcare trying to hold on to some momentum. But if you take a look year to date, we have seen technology really lead the way, communications and industrials. And so we'll see if that holds as we make our way into the last few trading days of the year. I do want to take a look at the Nasdaq and the latest action there. If you take a look year to date, this has been a story largely led by NVIDIA. We'll see if that holds on though. But intraday trading today, we are seeing a bit of a mixed picture here, with NVIDIA moving higher, up about 1% for that Grok deal. Also Apple, Costco, Qualcomm in the green this morning, but mostly a mixed picture with Tesla down about 1%. We also have Palantir down about 1% as well, as we make our way into one of the last trading sessions of this year. I do want to get to gold, because gold is extending its record rally to close out a blockbuster year. The precious metal has hit more than 50 all-time highs, and it's on track for its biggest annual gain since 1979. Now, the historic run has been driven by economic uncertainty, market volatility, and geopolitical tensions, and some analysts see more room to run. Joining us now to break it all down is Bob Iaccino. He's the Chief Market Strategist at Path Trading Partners and co-host of the Futures Edge Podcas. Bob, let's talk about gold's performance this year, because it has far surpassed the S&P 500. Now Goldman Sachs predicting that it could hit 4,900 by the end of 2026. So what's your outlook for the new year?
Well, I've been long gold for a couple of years, Brooke. As you know, I talked about gold in 2023 on this show, as a matter of fact, as being one of the big holdings going into 24. And I've seen no reason to get out of that position at this point. I do think we'll get a substantial pullback, but I think the central bank buying is going to resume and accelerate into 2026. I think this is sort of a de-debt, de-US debt, de-dollarization, sort of a narrative that has not changed globally. So I see that continuing. And that, of course, was some of the geopolitics that went on over the last couple of years are a big part of it. So I don't really see that ending, but I don't see the type of parabolic move we've seen in gold continuing. I think those who are long gold need to stay long gold, but I don't really think it's time to initiate new positions in the precious metals.
So Bob, it seems like you're kind of contradicting what exactly we're hearing from Goldman Sachs. We heard from global data this morning. They're predicting between 4,900 to 5,100 by the end of next year. Walk us through that hesitation that it seems like you have. And also it seems like investors shouldn't be jumping in right now. Is that what you're saying there?
Well, I think that's sort of given where gold is, I don't think that's a very big call. And that's sort of what I mean. I mean, when you mentioned the kind of rally we've had this year, I just don't see that continuing. So you get to a certain point with commodities, especially where you've seen such a run that the reward to risk on getting into new longs is not necessarily that intelligent for me from a trading perspective or from an active investing perspective. The kind of thing that I do when I get these big runs is I rebalance, take some of those gains and put them in more constructive areas like some of the AI sectors, for example, which have also had big runs, but have sort of leveled off over the later part of 2025. So it's not that I'm disagreeing with Goldman Sachs. I just don't think it's a very bold call, and it doesn't call for new gold positions in my view.
Now, some of the other areas of this gold trade that have seen such momentum this year include some gold miners. We have Barrick, Freeport, Newmont seeing tremendous returns. We also have ETFs also seeing tremendous returns as well, with Van Eck Gold Miners ETF up more than 160%. What do you make of investors trying to play this gold trade maybe a little bit differently? And is that the right move in the new year?
So that might be a more conservative way to play 2026. And I'm glad you brought that up because some of the gains that I made in the commodity itself, I moved into the Van Eck fund specifically because it's going to have a little bit more complex of a move than gold itself. One thing I've talked about for years with precious metals and also with energies like crude oil is that if you have a thesis in the commodity, you should be invested in the commodity, not in the oil drillers or in the large oil companies like Valero or Exxon. If you have a thesis in oil, you should be in oil. I feel the same thing for gold, except when you end up in a situation where the price of gold might stabilize. The miners are still going to be taking advantage with larger margins of this higher gold price, even if gold stabilizes, and their P&Ls and their profits and their earnings report will reflect that. So some of the places you could establish new longs, if you believe in Goldman's call or anyone else's call for that matter, because there's not a lot of calls for gold to drop off the face of the earth, you're looking at the miners as being a better play in my view.
Bob, another precious metal that has seen a 150% return this year is silver. We are seeing some momentum this morning. Break down what's driving this momentum on one of the last trading sessions of the year, and also that run that we've seen this year to date.
You know, historically, silver has suffered from its classification as being both industrial and precious, because the precious metals could be rising, but then silver could have a headwind from the industrial sector in the case of when gold is rising during recessionary periods. This particular story is huge for 2026. So silver has the precious metal component, not as strong as gold, but it also has the electrification story, the AI demands for electricity, not as strong as copper, but it has both. So this is the first time in recent history where silver has gotten to take advantage of that. Now, again, parabolic moves, you have to be careful about new entries, but silver itself can fall 15% and is still probably a good buy for 2026.
Bob, you mentioned that within the answer that it hasn't seen the same sort of demand as copper. I do want to get on copper because it's on pace for its biggest annual gain since 2009. Break down what exactly is driving that demand and just how much has to do with it with this AI build out that we're planning to see in the year to come.
Yeah, it's interesting with copper, as we saw the green energy story kind of fade into the background. It's not gone, but it certainly has lost its sort of momentum. You're seeing the AI electrification and the build out that has to happen. One of my key stock picks for next year is actually AMD. I was happy to see the interview that just preceded this show. And that, again, the build outs, those things are not going to end. They're 3 and 5 year stories right there. So copper is going to benefit from that. I think copper is one of the best commodity plays for the medium to long term. For me, medium term is 5 years. So when you're looking at it from that perspective, I think copper is going to continue to operate in a structural deficit when you look at the projections of the need for this particular industrial metal.
Bob, all eyes on gold, silver, and copper to end the year. Bob Iaccino, thank you so much for joining us and have a happy new year.
Good to see you, Brooke.
Coming up, 2026 could be a blockbuster year for the IPO market. We're taking a look at the key IPOs to watch next on Market Catalysts. 2026 could be the year of the initial public offering as investors keep a close eye on all the talk about OpenAI and SpaceX going public. Yahoo Finance's Josh Lipton spoke to Greg Martin. He's the managing director of Rainmaker Securities about what's ahead.
Greg, it is always great to see you. So here, Greg, it was a choppy 2025, you say, for the IPO market. Highlight tariffs, rate uncertainty, the government shutdown, of course. So what do we expect looking ahead, Greg? What's going to happen in 2026 that gives you cautious optimism here?
Well, Josh, good to see you again, and thanks for having me. We thought 2025 was going to be a big reopening of the IPO market, and as you point out, there were some issues, tariffs, rate uncertainty, but I think that is behind us largely. Obviously, we're seeing a very good GDP print coming. Inflation's lower. We're now officially in a rate decline, a interest rate declining market. And of course, markets are at all-time highs, and we still have this amazing backlog of really solid private companies. Many, even centacorns, if you will, $100 billion market cap companies. Any one of which, if they went public, would actually dwarf the total amount of proceeds raised, at the end of 2025. So I think there's a lot of really good elements. The VIX is low right now. So again, there's always risk. There's always things that could pop up. We could have some unusual geopolitical events like we did in 2025. But I think the market right now is set up for a really big 2026 IPO, and the pipeline is so good that it wouldn't be a surprise if we just got back to something closer to 2021 levels.
If you were to rank, Greg, the catalyst for IPO issuance next year, can we rank what matters most, Greg? Is it rates? Is it stock market stability? Is it a few headline making big names testing the public market successfully? How would you rank these?
There's a little bit of all of the above. I think stability is usually the most important. I think when you think about a new issuance, there's inherent risk in any new issuance because the company hasn't been public before. So it's testing the market for the first time. So I think stable equity markets is usually number one for me. So I like to follow the VIX when the VIX is low, which like it is now. That gives me more comfort. Obviously, when you're in a declining interest rate environment, people are going to cycle over to equities. That's usually a positive. But clearly people are going to watch the success of new IPOs. So I think when an IPO performs well, that will usher in new IPOs because people are going to want to access the market because they see a receptive demand for their IPO. So they're all important, but I think the number one most important thing for me is just a stable equity market.
So we talked about reasons for optimism next year, Greg, right? What are some risks, though, we need to think about? What are some, potentially negative factors that would be on your radar?
Yeah, we still have a volatile government situation. We're still worried about another government shutdown. Obviously, we thought the IPO market was going to reopen kind of after Labor Day. And then, of course, we had the government shutdown and nothing was going public. The SEC was shut down. So, we definitely have to watch, the government and whether it's open and open for business. There's obviously geopolitical events that can happen that are sort of more macro in nature, and that's going to cause volatility. There is an issue where right now we have a market that's really buoyed by the interest in AI, and it's obviously really floating the equity market significantly. So I do think that you have to watch all of those potential risks. But right now, everything feels fairly stable. And as I said before, if we see stability, if we see predictability, I think we're going to have a good market. But we have to always be careful about those potential factors that could be negative.
You mentioned AI, Greg, just to stop there for a beat. Perhaps some jitters there, at least in the public markets. I just looked, Greg, at NVIDIA off its 52-week high there, Broadcom off its 52-week high. But what are you seeing on the ground here? From your, you look at through a different kaleidoscope. Is there just as much excitement about that AI trade and trend, Greg, as if I asked you, 6 months ago or 12 months ago?
Yeah, the AI trend is always a little precarious. Every quarter we sit and we watch with bated breath NVIDIA's earnings report, just to see if it's still going. NVIDIA is obviously, the benchmark for everything AI because everyone's pretty much a very high percentage of people are buying their chips to push AI. It's right now we're in the build phase of AI. We're still very early innings, and one of the things that will start to be measured is the ROI of of AI applications. Are consumers, are businesses seeing return on investment of AI? Right now, they're buying it, they're experimenting with it, they're trying it. There's a lot of promise around AI, and so we're going to start to see whether whether the money is worth what they're actually getting in terms of increased productivity. So far, the returns are somewhat mixed, and I don't think we're going to know anytime soon because AI continues to improve. But the infrastructure side of the game, which starts with NVIDIA and then goes to GPU infrastructure companies like CoreWeave, which was still up 100% this year, even though it's been pretty volatile. There's a new company that will likely go public in 2026 called Lambda Labs. There's a company called Crusoe. So we're seeing it in the private markets. There's definitely been mostly upward pressure. We're seeing OpenAI talking about a $800 billion financing. We've seen Anthropic, meteoric rise this year. XAI is raising money. So the infrastructure side has been very strong. But at some point, the rubber's got to meet the road. People have to start seeing return on the investments they're making in AI. And that will be the biggest thing that will press it up or down. But I think it's too early to tell at this point.
You mentioned a couple there, Greg, but I'm just curious, what other names are on your radar here that you think, okay, these are names that could be IPO ready in 2026?
Yeah, I think there's a fairly large list of big companies, that are kind of 10 billion market cap and up. There's companies that have talked about going public for a while, like Canva, which is a SaaS presentation company. There's a company, called Ramp, which is in kind of the expense and card management space. There's a company in the human resource software business called Rippling. There's a payroll company called Deal. There's a messaging business, Discord, we've talked about for a long time. Motive, obviously, you mentioned, just filed to go public. And then, of course, there's the really big guys. There's the SpaceXs that have talked about maybe going public, sometime mid to late 2026. That would be potentially $1 trillion market cap, could be $100 billion, raise. There's OpenAI, I just mentioned. There's Databricks that have been talking about going public. They just raised a round, valuing them at $130 billion. There's Stripe that is always on the radar. I mean, these are companies that could go public at any time. And so I think there's the mega names that, if they go public, are really going to create a groundswell. And then there's the smaller companies that I just mentioned. So there's a good long list and that's just the tech sector. I'm not even covering, mostly some of the other sectors, but so there's a good long list of companies that could really create a groundswell of IPO interest this year.
Yeah, I want to end there on that point, Greg, because I think it's interesting. I mean, let's say you had a really high profile mega name go public next year. I mean, let's say, Greg, it was SpaceX or Anthropic or OpenAI. I'm just curious, what kind of ripple effects could that really have on the broader IPO market? What can that mean, Greg, for IPO issuance or sentiment?
Yeah, well, when you're talking about a SpaceX or an OpenAI, you're talking about potentially raising $100 billion, which would be the largest IPOs in history. So you're really testing the how much interest there is in new issuances there. So you're really, it's a real big test of the capital markets and whether a company like that can come public and raise that amount of capital. And it just sort of goes to test how much money is really on the sidelines waiting for these companies. And we're in a market that's kind of dominated by the Mag 7. And so if you want growth, you're investing in those. And where most of the growth today is in the private markets. And so it's a real test of, when you can finally access these great private companies, how much are people willing to open up their wallets and invest in these businesses? We've seen, because of the scarcity of these companies in the private markets, their valuations have gone up significantly. But when they kind of come out, they got to present themselves publicly. It'll be really interesting to see just how big the universe of potential buyers are for these companies in the public markets.
Greg, always a pleasure to have you on the show, my friend. Merry Christmas.
Merry Christmas. Have a great holiday.
Coming up, consumer is getting a Christmas gift at the gas pump this year. We're breaking down whether prices will stay at 4-year lows in 2026. Stay tuned. Some relief for the over 100 million Americans that are hitting the road this holiday season. Gas prices are now below $3. That marks the lowest level seen since 2021. It also represents savings of $500 million for Americans. Joining us now is Patrick Dehan. He's head of petroleum analysis at Gas Buddy. Patrick, break this all down for us. Almost Happy New Year to you as well. What exactly is driving these lower prices right now?
Yeah, good to be with you, Brooke. A lot of this really stems from lower oil prices. Oil being at multi-year lows, of course, back in March of this year, OPEC started ramping up and increasing oil production. That's been kind of the name of the game here. The Saudis have led increase. A lot of OPEC members back in the prior years were relatively upset about constrained oil production quotas, while OPEC this year decided to raise those. That additional oil has been pushing down refined product prices like gasoline and diesel. As you mentioned, it was the cheapest Christmas since 2020, and it's looking good for 2026. That is, as long as OPEC continues on this path to oil production numbers increasing, it's going to mean oil prices may struggle. The good news is U.S. oil producers holding relatively resilient, at least for now. U.S. oil production still up about 3 to 4% from last year. So the question is how long this low price era will continue, though. Of course, infamously back in years ago, we saw low oil prices that then led to a bit of a catalyst and brought back higher oil prices. So don't expect this to last multiple years, but for now, I think the road is steady, and 2026 looks like it may be another nice year for motorists.
And Patrick, something impacting this news out this morning on this geopolitical tension that is impacting supply. Crude oil was set to have its best weekly gain since October. Now we're seeing some pressure there. Break down what exactly is happening there and what this could mean for 2026.
Yeah, we've seen a lot of geopolitical issues in the past year. Of course, what happens in the Middle East, the attacks on Iran, Israel and Iran, Russia and Ukraine, and now more recently, Venezuela and the United States. And this is something to keep an eye on. Venezuela is the world's largest proven oil reserves, or the country with the world's largest proven oil reserves. So a lot at stake here. Venezuela has seen their output plummet over the last couple of decades, over Maduro's era, and of course Chavez before Maduro. And so investment there has been low. Of course, Chevron being the only U.S. company that can still drill there. But the blockade that we're seeing the Trump administration now actively going after some of these blacklisted crude carriers is something that could shake up oil prices moving forward. Now, ultimately, if there is regime change in Venezuela, that could potentially open the door for additional oil production. But for now, that blockade is essentially blocking that oil from Venezuela from making it to the global market. So in the short term, we could see upward pressure on oil prices as this blockade continues, but that could pave the way for long-term improvement when it comes to oil prices. And that's something that we'll have to see if it tips the scales in 2026. But ultimately, another relatively favorable year ahead, I think, for most motorists. Diesel, a little bit of the exception. Industry likely to have to pay a little bit more for not only diesel, but keep in mind natural gas. I mean, big parts of the AI conversation. We've seen some of these data centers building natural gas production facilities or natural gas power plants on site. And you're also seeing some of that happening with diesel, too.
Patrick, to keep this conversation back home, Americans a few years ago, they were seeing $5 at the pump, and that had a profound impact on consumer sentiment about the way they felt that things were going about the economy. And now, yes, we're seeing gas prices at $3, but we're also seeing Americans face an affordability crisis with higher rent, higher child care costs, also higher health care costs. So how are you thinking about the impact that gas prices, albeit lower, have on consumer sentiment right now moving into the new year?
Yeah, Brooke, it's kind of a self-fulfilling prophecy for some Americans. They view falling gas prices as a sign of economic duress. I don't yet think that's the case. Gasoline demand still holding relatively strong. To your point, though, in an era that you see inflation at the grocery store and in your rent and tax bills, it's certainly good news that Americans are going to be spending likely tens of billions of dollars less on gasoline in 2026 than 2025. And that's been, by the way, now a 4-year trend ever since the peak in 2022. Of course, back then, the economy had reopened. Russia's invasion of Ukraine created this super cycle, and we've been seeing prices moderate. 2026, not a whole lot of energy price inflation when it comes to petroleum, or at least I should say downstream products like jet fuel, diesel, and gasoline. And that could help motorists feel a little bit of relief when it comes to some of the skyrocketing other costs you mentioned, like rent and grocery prices, which may remain stubbornly high.
Now, this holiday season, 2% more Americans are expected to travel. They're expected to do more year-end road trips. What does that tell you about the way that Americans are thinking about just how much ability they have to travel in this sort of environment where they're really cutting back? They're being more choiceful, maybe choosing to hit the road instead of flying?
Yeah, Brooke, I mean, look at it. It's the one good that gasoline, you see it no matter if you need it or not, right? It's almost on every other street corner. So Americans have this affinity to gas prices. And when they see them low, you're right. Some people feel really good about being able to take those road trips or maybe spontaneously go somewhere for the weekend, even in winter. Maybe not so much as we see in the summer, but absolutely. I mean, that gives Americans somewhat a positive feel of being able to do those things. So lower gas prices on one side of the political spectrum lead to freedom and positive feelings. But on other sides, like I mentioned, there's some Americans that are suspicious that low gas prices could be a sign of a failing or slowing economy. And a lot of those feelings come back from COVID when gas prices plummeted and it was a sign of things were going to get a lot worse. This time around, these low gas prices are not yet necessarily a sign of a recession or a slowdown. They're a sign of increased supply. So let's get that correction out there. But yeah, a lot of Americans certainly starting to enjoy these lower prices, especially now 11 states where we're seeing some stations below the $2 a gallon mark. Certainly really eye-popping to see some of those figures that we're seeing across some U.S. gas stations.
Wow, below $2. I saw in your notes, Oklahoma, Arkansas, Colorado, some of the states seeing some of the lowest prices. And hey, if you're hitting the road, maybe we're heading there. Patrick Dehan, thank you so much for joining us, and safe travels to you and your family this holiday season.
Happy New Year, Brooke.
Coming up, the outlook for the consumer internet sector, which stocks are best positioned heading into the next year. Stay tuned. You're watching Market Catalysts. We're watching shares of Target after a report from the Financial Times suggests activist investor Tom's Capital Investment Management has built a position in the retailer. Now, the FT did not report the size of the stake, but Target has struggled over the course of 2025 with its market cap shrinking by about a third. The retailer will be undergoing a management change early next year. CEO Brian Cornell is stepping down and will be replaced by longtime executive Michael Fidelki. Now, in a statement to the FT, Target said, quote, Target's top priority is getting back to growth, and our strategy to do so is rooted in three strategic priorities, leading with merchandising authority, providing a consistently elevated shopping experience, and leveraging technology. The hedge fund has recently been pushing for changes at Kenvue, that's the maker of Tylenol, which was sold to Kimberly-Clark last month in a nearly $49 billion deal. 2025 has been a positive year for consumer internet stocks, and according to Wedbush, 2026 will be a year of both winners and losers. Yahoo Finance's Inez Ferre spoke to Scott Devitt. He's Wedbush Securities Managing Director of Equity Research about his outlook.
Scott, let's start with your top picks heading into the year.
Sure. Thanks for having me. The four names that we've identified as top picks for the year are Amazon, Meta, Mercado Libre, and DoorDash. And we have more overweight ratings than those, but those four really stand out.
And talk to us a little bit about why. I mean, when you're talking about Meta and others, what are the driving forces going into 2026?
So you have, in each case, a period of underperformance related to mostly investment cycles. Amazon has spending around AWS and AI infrastructure, which is going to start, I think, to pay off in 2026. And you're going to see an acceleration in the AWS business, which investors will like, and that should help the stock perform. Meta, is on the very front end of an investment cycle. Growth is extremely strong. And I think as investors get more visibility to the spend and into the second half of 2026, that stock's going to recover quite nicely because the dollars are going to be proven to be well spent. And then Mercado Libre and DoorDash also similarly, that they're spending to grow. We had a period of digestion in 2022 and a period of operating leverage in this sector in 23 and 24. As we've entered 25 and gone through 25, it's normalized, and in 26 you're starting to see investment cycles again. There's nothing wrong with that. I just think it creates an opportunity in terms of the pullback in the stocks that when you get to the other side of the investment cycle, you get to experience excess returns. So it's a very back half weighted set of recommendations that we think will perform well over the next 12 months.
And one of the big themes this year has been driverless driving. You've got AI that's been a massive theme. So talk to me a little bit about how you're seeing these themes going into 2026. Robotaxi, AI.
Autonomous it's going to be the year of autonomous, frankly, particularly in the US with the expansion of Waymo into as many as 20 markets in 2026. Our estimate for Tesla is that it enters 30 US markets by the end of 2026. And you're beginning to really see the early stages of a transition from human-driven activity to one that's run by robots. And it's very exciting. It's good for society. It's good for the health of consumers, given that it lowers traffic deaths and incidence rates. And so I think autonomous is something that could be a headwind for companies I cover. Lyft and Uber in some ways could be beneficial in other ways, and certainly will be good for Waymo and Tesla. On the AI side, a lot of the benefits the past 2 to 3 years in terms of security prices have come with infrastructure plays. I think you're going to start to see a transition more towards use cases, enterprise and consumer use cases. And, these things kind of being found in the wild now and starting to see the ability to quantify the returns. Meta's been an early beneficiary of incorporation of AI into the business. And I think you're seeing more companies as well in 26.
And looking at Lyft and Uber, Uber has done well this year. And I'm curious, is that because of Robotaxi and how you see the competition between some of these players shaking out? You've got Waymo that has done so well, and then you've got Tesla that is also making advancements, and Tesla, which touched all-time highs this year. So I guess I'm just curious as to how you see it all shaking out within those players.
So Uber and the performance year to date, it's a little tricky because it did underperform exiting 2024 on fears of autonomous, and then recovered this year as autonomous has been held at bay and hasn't really impacted anyone's business quite yet. And so I think that performance looked at over an extended period of time, called the next 18 months. Uber's been relatively flat. I think Uber as a company is a bit more insulated than Lyft because it has a delivery business for restaurants as well, which is about half of the gross bookings, and also has a significant business outside the US. In the US, autonomous is ramping quickly, and I think it's only going to accelerate on an S-curve type pattern in 2026. And that really exposes Lyft, which has over 90% of its gross bookings in the US. And so I think that you're going to start to see the effects of that in the share price, which has also done well this year in 25, could come to an end in 26.
And I've got to get over to Carvana because this company is now in the S&P 500. This company was left for dead back in 2022. I remember when the stock price was around $4 a share. If you were investing at that time, at the end of December of that year, you would have made 10,000% your investment over the last couple of years. I'm just curious as to what did they do right? And do you see other companies or players that can make that massive run over the next couple of years?
It's almost 100 bagger from the end of 2022. It's amazing. Now, it took quite a lot to get there because the stock declined, quite a bit in 22. But that being said, Carvana has similar characteristics, I think, to something like Amazon, where there was a capital build and fears earlier in Amazon's life around, and Netflix, frankly, too, building its content portfolio, where investors thought there was bankruptcy risk in all three of those companies, and each has come out the other side over time. And I think Carvana, this is the moment this past 2 years when it's really proven its mettle and its competitive position. Used autos it's an industry that consumers. Anyone that's purchased a used car over their lifetime, grows to hate. And so the opportunity to kind of improve the industry was there. They enhanced the business model going direct to consumer, and they turned their inventory better than their competitors, including CarMax, beat CarMax by about 35% in inventory turns. It's a declining commodity cost industry, so inventory turns are critical. And I don't really see anything stopping Carvana from continuing to gain market share. Now, it's been a massive move in the stock. So, we have an overweight rating on it. I don't know that I think it's one of our better ideas in that category right now because of the move. But over the next 5 to 10 years, Carvana is just going to collect market share at an accelerating pace. It's kind of amazing.
As a buyer of a used vehicle this year, I will say that I concur. It is frustrating to buy a used vehicle, but I did it after months. Thanks so much, Scott, and Merry Christmas.
Thanks. Merry Christmas.
Coming up, financial resolutions for the new year, how investors should be thinking about their portfolios in the final days of 2025. That's next on Market Catalyst. The new year is just a few days away, and Americans are thinking about how they want to tackle their finances. According to a poll from Ipsos, almost all Americans have already set or are considering financial resolutions for their 2026 list. Here for this week's FA Corner, brought to you by Catapult Group, is Dale Smothers. He's RDS Wealth Management CEO and President. Dale, great to have you. Let's start big picture here, because in 2025, we face geopolitical uncertainty. We face AI bubble risk concern towards the end of the year. Now in 2026, you say none of that is going away. So how should investors be thinking about their portfolio positioning in these final days of trading?
Yeah, good to be with you, Brooke. Realistically, I think this boils down to one word going into 2026. If you have a financial, or let's say an investor's New Year's resolution, it would be to maintain discipline. That's the word, discipline, going into 2026. All of these things that you mentioned will continue. We'll see headlines push the markets up, push the markets down. And I like to think of those as overreactions more times than not. And the reality is, if you have a disciplined mindset, an approach to your investments based off of a plan rather than overreactions or reactions in general, this is going to bode well for you going into the new year.
Dale, I think it's worth noting that RDS Health Management does really focus in on retirees. Volatility, though, really is the name of the game over the past 2025. For those who are thinking about retiring soon, and really at any age, how do you sort of withstand that volatility? How do you maintain that discipline in this very, here and there market?
You're exactly right. The reality is, at RD Smothers Wealth Management, we focus specifically on retirees that are entering into what we call income phase. You transition from growth phase into income phase, and there has to be a mindset shift. You can no longer chase the returns. It's more about stability. We like to say income first, growth second, protection always. And when investors invest this way, this financial market news that we hear every single day, it becomes background noise that we can tune out. RD Smothers Wealth Management, we like to think of ourselves as maybe some noise cancellation earphones, right? So we can cancel all that noise out. And the way we do that is by subscribing to this rule first, that losses will hurt us more than gains will help us. Building this type of portfolio on a risk-on, risk-off portfolio basis, where we've got some money that's stable for income purposes alone. We can pull from that even in down market years. Having some money that's out there clearly chasing these optimistic returns that we're seeing in the markets of 2025 and even 2024. This balance between risk on and risk off is how we approach years like 2026.
Dale, when you think about how exactly investors should be setting time horizons for this market, where they're willing to take some risks, they're willing, to pull back a little bit, at any age, whether you're about to face retirement or you're just getting into this market now, how should you be thinking about the time horizon that works for you as an individual investor?
People are sitting on retirement accounts and just investment accounts in general that are larger than they've seen in decades, Brooke. This is probably a high of most investors' retirement accounts because we've seen significant run-ups. If you participated at all in the markets, this is a perfect opportunity to revisit your portfolio and make sure that it is still built for the lifestyle you have today, not the lifestyle you had 5 years ago or the lifestyle you maybe even had just 5 months ago. Times change, desires change, needs change, and that time horizon should be front and center. As you mentioned, reevaluating where your time horizon is compared to the amount of risk that you have in your portfolio is certainly going to help you withstand these overreactions in the market that are sure to come from all of the headlines.
Dale, real quickly here, one big beautiful bill is set to see or lead to larger tax returns next year. How should investors be thinking about that ahead of next year when they go to do their tax filings?
So again, at RDS Wealth, we build retirees portfolio that is really addressing all 5 worlds of retirement. Tax planning is one of them. The big beautiful bill needs to be front and center with your advisor inside of your plan, reevaluating the tax benefits that you may receive, maybe even some additional taxes that you may find in the small print that you may end up paying. This type of tax planning needs to happen every single year, and a piece of legislation like the big beautiful bill is a perfect opportunity to reevaluate your overall tax plan. We like to think of this as an opportunity with smaller, hopefully smaller tax bills for Social Security recipients, for those over the age of 65. This is a great opportunity to look at Roth conversions as a potential if you have some extra room in your tax bracket, something we call opportunity zones that appear in the tax brackets for retirees.
Dale Smothers, so many great tips. Thank you so much for joining us, and Happy New Year to you.
Happy New Year, bro.
That was FA Corner, brought to you by Capital Group. And that's it for Market Catalyst. I'm Brooke Tupama. Thank you so much for watching, and Happy New Year to all of you out there.